Global value chains have become active for even very simple products like bicycles, like we are wearing shirts or chocolates.
Our true export success story should be one that is also led by small and medium enterprises.
We need a lot of thinking and changes in our production, in our designing, the way logistics, customs, everywhere we need to improve a lot.
The additional stimulus that we need to accelerate to an 8% growth has to come from exports. That doesn't seem to be happening.
Small level problems at the drainage level, we have to clear the drain, and those problems are run into hundreds for each sector.
Welcome back to Tracking Trends. Today we are going to be talking about the latest trade data that came out earlier this week. Headline takeaway was that trade deficit narrowed in the month of February. Now, trade deficit could narrow for either of these two reasons. When exports grow faster than imports, trade deficit could narrow, and that's good. When exports grow slower, but imports grow even slower, you could still have narrow uh, trade deficit narrowing. But that is not good news. The later is what happened with the February data. But looking at data for one single month is not the best way to assess how your economy is doing on the external front, primarily in its trade engagement with the rest of the world. We are going to take a look at longer term trends, locate the data that have come in for February, locate the data now we have for the April February period, which is almost 11 months or almost the full financial year, in the larger context of both data, developments, and policy. And for that, we have today in our studio Mr. Ajay Srivastava, who is a former trade officer. He has been part of several WTO and multilateral trade negotiations for the government. He's skilled in trade policy, analytics. He is a regular columnist in several newspapers, including uh, basispointinsight.com, with which this effort of ours is also associated. He is also the founder of the Global Trade Research Initiative, a data driven virtual think tank, you may say. Welcome, Mr. Ajay Srivastava, and let's start telling our viewers a bit about what the numbers for February say. And as I said, and then let's take it from there.
Thank you, Rajesh ji, for inviting me for this great show. So, you know, as you rightly mentioned, that we have to focus on, of course, the February data, monthly data, but we also have to look at the long-term data. So, February data, two parts. Services, as usual, are doing fine. They are growing at the speed of more than 8 to 10%. Merchandise exports, they fell down by almost 11%, 10.85% to be precise. But things are not as bad if we look at the longer term, which is the financial year data, which means April to February data. So while February exports are down by 10.85%, our April to February data, they are equal to last year's data, April February 2024 data. So they are almost equal. In fact, there is a growth of 0.06%. I'll say they are equal. So merchandise exports for this year, if the trend continues, we will not be crossing last year's figure. Last year's our merchandise exports were $437 billion, April 23 to March 24. This year we will not be able to cross that figure, but we'll be almost touching the figure 1 or 2 billions here and there. So that's the analysis that long term, which means year long, our exports have performed better. February, of course, there was a downfall, and there was a reason for the downfall in February. Most of the export decline can be attributed to two factors: decline in the petroleum product exports and the decline in the gems and jewelry exports. Petroleum products, we can understand why they are declining. Petroleum prices, they have come down by almost 8 to 9% compared to last February figure. And gold, of course, we see that sudden surge of import was there in last few months, so it had to come down. So it has come down. So these two explain most of the decline in February.
So, just to recap, exports in February are estimated at $37 billion. This is export of merchandise goods, which is almost 11% down from $41.4 billion in February last year. If we look at the April, February first 11 months of 2024-25, the current financial year, uh, it adds up to merchandise goods exports adds up to about $395 billion, which is almost same. In other words, we are having zero growth in exports of merchandise goods.
Yes.
The saving grace has been services, where we see a certain amount of growth, modest growth happening, which is what we are expecting will leave us somewhere again around roughly $400 billion. And overall, we may end up notching goods and services exports a growth of 6%. But we take note of the fact that much of this, in fact, almost all of this 6% growth is coming on account of services. In exports, there are no growths. Now, my question to you is 6% growth in goods and services good enough if our ambition is that our broader economy, we want to take it on to a higher trajectory of 8% growth? The additional stimulus that we need to accelerate to an 8% growth has to come from exports. That doesn't seem to be happening.
So, Rajesh ji, you are correct, but we must know that exports are, we have to sell to other countries, and the growth of exports in most countries is down. Only India and China, their growth is on the positive side, and they are pulling up the overall global export figure. So, internationally, it's a tough time for everyone, and we are happy that because of services we are able to contribute in a positive way. India and China are the two major countries which are pulling up the global export growth in a big way. It's tough, it's down, but still we are doing better than most people. Of course, we have to focus on our merchandise sector. There we are not doing good. We need to do many more things, but to understand this better, I want to divide this merchandise trade into several subsectors to understand how they are performing. I divided entire merchandise exports into four categories. So the basket is into four categories: green products, and the two criteria, very simple criteria we have taken. So we say, let's say growth in April to February, and second parameter is growth in February alone. So there are certain product groups which are growing in both the categories. April to February, they have grown, and second, that is long term growth. April to February is long term, and then February short term growth is there. So based on this, we divide into four categories. So there are green products where growth in both long and short is positive. So we are safer with those products. And there are product groups where growth is short, growth is negative in the long period, April to February period, but it's positive in the short period, February alone. Then the reverse, there are products where the growth is good in the longer period but bad in the shorter period. And then the products where growth is bad in both the periods. So let's deal with each of these. So green color I have allocated to where growth is positive in both the periods. which are these. So we are very happy with the growth because these sectors are growing very nicely in and they will continue to grow. Electronics, electronic sector is growing. It grew in the long period and the short period. Ready-made garment, it was losing market share for the past several years. So it's a very happy finding to know that the sector is turning around gradually, and it has grown in April to February also, and February also. We are happy it is taking off. We hope the trend continues. Then on the agriculture side, meat and rice, they have grown both in long and the short periods. Then coffee also has grown in the long and short period. So these are the major product groups which are green. So we hope this growth continues. And these product groups, they account for about one fifth, 22% of India's merchandise trade basket. So this is about the green, where the growth is happening, and we hope it will continue these things. Then we talk about orange. Orange means almost green. So long term growth is good, but short term February growth is negative. So here, engineering goods. It grew whole year, but suddenly in February it fallen down. Drugs and pharmaceuticals, growth whole year, February fallen down. Plastics, and then yarn, cotton yarn. So this is a very major category. 51%. I mean, almost half the merchandise trade. Engineering alone accounts for about 25%. Then engineering, drugs and pharmaceuticals, plastics, yarn. So here growth long term was good. February is declining. We must invest all our energy to investigate why it's happening and take remedial measures. So, and this is the biggest group, 51%. Now, third is brown group, where growth in the long term was negative, but suddenly in February it has jumped up. So some green shoots are there. So marine product is the key example. This account for 2% of India's exports, and we should be happy about this, and we should find out why the it has turned from negative to positive, and whatever has turned it positive, we should keep on continuing taking those measures which has turned it positive, because year long it was negative. Suddenly in February it's positive. So we have to, but this and finally the red, negative, negative, long term negative, short term negative. We have to worry about this. And petroleum products, it's a big thing. And then gems and jewelry, and then ceramics, iron ore, oil seeds. This sector accounts for one quarter, 25% of India's merchandise export basket, and it's negative in the long term, negative in the short term. We have to really be focusing on these products. Of course, there is not much control over, say, petroleum prices. If crude petroleum prices they come down, of course, our export prices of the products which we process the crude and make it, they will also come down. So not much control is there, but we also see why ceramics are in the red. Ceramics we did very well in the past few years, and then why oil seeds are declining. And so we have to find out the reasons and ascertain if we can do something. So the sector is red in long and short both. So this is my summary about why what is happening at the sector
No,
level. I stop here.
this is excellent, and this is why we have you here, because someone who understands analytics and who has dealt with policy and then knows what to do with data.
Yeah.
A lot of people can analyze data, but to kind of suggest policy action is what actually we need. So excellent. I think let's just stay for a moment here and look at the last category which you said, the negative, and that should be worrying because gems and jewelry, ceramics, these are also sectors that also generate quite a bit of employment.
Hmm.
Are you fearing that for some reason we could be falling off the global value chain?
I'm very happy you're asking this, Rajesh ji. So, when we talk about global value chains, we thought it's about complicated products like iPhones or laptops. No. Now, global value chains have become active for even very simple products like bicycles, like
Yeah.
we are wearing shirts or chocolates. I'll give one simple example. 20, 30 years back when we used to have a new shirt, We used to buy clothes from the nearby market and go to the tailor, and then it got stitched. And then 10 years back, we saw that, of course, tailors are vanishing from the scene, and we started buying ready-made shirts, but mostly made in India. But now, what is happening is that global value chains have taken over for all most of the premium quality shirts. So, what is happening? For example, let's take the example of cotton shirt. India makes great quality cotton, and we are the largest exporter of cotton yarn. We make the best quality cotton yarn, but we don't make great quality fabric for other reasons. We'll not discuss it here. So, so if a global giant like H&M or Zara, they want to sell cotton shirts to their global marketplaces, they'll buy yarn from India. They will tell Indian yarn exporter to export it to China because China makes the best quality of fabric. They convert the Indian yarn into fabric, best quality fabric at the cheap price. But China again is not the best place for dyeing, highest quality dyeing. So the fabric made in China moves to Spain for high quality dyeing. And then Spain is a developed country. Their labor cost is very high. So they cannot convert into garment because its hourly charges are very high. So the dyed fabric moves from Spain to countries like Bangladesh, Ethiopia, Vietnam, where it is cut and stitched by low cost labor. And then it moves to the thousands and thousands of storehouses of Zara or H&M across the world. From design, if a Zara designer approves a design and they take the decision to introduce a shirt, from designing to storehouse availability, less than 30 days time. So this is how value chains are have changed even for the simple products. I can go on and on about how bicycle value chains are coming up, how chocolates are made in 10 country collaborations, those things. So we have to know all these things. There are new ways of doing business to comply with their requirement that I decide today within 30 days my consumer will get it, otherwise fashion will change. So we are not geared up. We are gearing up. Top firms are gearing up, but we need a lot of thinking and changes in our production, in our designing, the way logistics, customs, everywhere we need to improve a lot. I think I stop here, and leather and textile, they suffered because of that only.
I think it's excellent that you explained it, and I think a lot of people would. I mean, some of it I also didn't know how this value chain, how deep now it runs, and how expensive it has become. And you said some of the top firms are gearing up, but our true export success story should be one that is also led by small and medium enterprises.
Hmm.
Now, the changes that you are saying, value chain, to catch up with that, top firms have their resources to strategize and organize themselves. But the MSME sector, SME sector, may not have those wherewithals. What is it that the government can do to back them up?
So MSMEs in India, they suffer from many infirmities. Even large firms suffer from them. So first is the if we forget about technology, access to technology, MSME cannot invest in high technology. But suppose low end product, simple products like shirts, they make the highest quality. They have the capability to make highest quality shirts as the large firms do anywhere in the global scene. But still, the access to capital is very limited, and banks they need guarantees for them, and most of the MSMEs they are unable to provide the guarantees. Then cost of capital it exceeds 10%. In China, it's less than 5% for these things. So access to capital. Then there are thousand things like uh, some modernization of the production techniques, and then uh, their connect to the global brands which can source from there. Global brands generally they don't have time, as we have discussed, so they go for the large manufacturers. So they have to talk to few of them only and to supply for uniform quality of the fabric. So what is happening is that if a large firm connected with the global value chains and a small firm, they make the same quality say shirt, Then large firm will be able to sell the shirt, say $10, but small firms will not be able to sell that shirt for more than $3 or $4. That's the difference between if you are connected to a supply chain, if you're not connected to a supply chain. So what government can do? Government, first thing, everybody knows that we have to ensure that they get the capital at the proper cost. First, they should get it. They don't get it any cost, most of them. And second, if they get it, they should get at the internationally competitive things. They're competing with the other countries where they're getting capital and they're getting access to technologies. The countries like US still have very very smart programs for promoting small businesses. Germany, they have the concept of Mittelstand, where Mittelstand means the engineering graduates of Germany, they will work half the time in the nearby factories, and they'll be learning here the best things available in the world, and they'll try to translate those there. And that's how Germany has become very big through small enterprises, which became big, many of them. We need to do a lot of groundwork. We are, like I discussed about capital alone. So there are 10 factors like Mittelstand type of models. Why we cannot do? We have thousands and thousands of good quality engineering colleges. We have lakhs and lakhs of MSMEs. Why not link each college with the 2 3 MSMEs where best student go learn there? Of course, instead of doing rote learning and learning theoretical things, they will learn something, learning by doing. It will help MSMEs improve their management structure, improve their technology, improving the best practices, and the students will be learning something good, something practical.
We keep talking about we have to take action, and we have been actually, when it comes to exports, I know you said the 1 year thing isn't that bad, but when one takes a longer term look at things, total export of goods and services 10 years ago were about 460 470 billion dollars. By a simple 8 to 10% growth, which is what we actually had crossed, when we before that we had crossed, and even 8 to 9% growth should have taken us beyond 1 trillion. And we talked about crossing 1 trillion in 5 years. We talked about into 2015, 2020 past pandemic year and all that. But here are some of the data points I wanted to flag and seek your views. India's the export share in our GDP was about 13% in the year 2000. From there, we did fantastically well, almost doubling that share by 2013 to 25.4%. And that performance on export front also showed on the fact that during that decade we almost averaged close to 8% GDP growth, and so many people went up, so many good things happened to the economy. From 25.4%, today we are down to almost 21%. During the pandemic, it had fallen to 2020, it had fallen to 18.7%, started coming up, but again, it has started going down. And as you are saying now, global factors are such that it is unlikely that we would see any trend reversal. Now, my question to you is that 2013, we had reached 25, almost a quarter of our GDP came from exports, and global trade was growing then. We just simply kept sliding. Uh, is there something seriously wrong that we probably know, but we just are not able to do anything about it?
Your prognosis is absolutely correct, but I want to tell you that big economies like US, China, Japan, or even India, we are not an export driven economy. Exports is an outgrowth of the economy. Why I'm saying this? So, export to GDP ratio, as you rightly said, it for China it's about 21%, India nearby 20%, Japan 18 19%, US is 11 or 12% only. So we are large economies. Large economies export doesn't lead the economy. it is an outgrowth of the economy. And now compared to the smaller economies, smart economies, Vietnam, export to GDP ratio is about 90%. Ours is 20%. Okay. Singapore, maybe more than 150%. So when we compare India with Vietnam, that Vietnam is doing so well, we have to recognize that you have to make sacrifices to make you an export-driven economy. That sacrifices maybe at the cost of local industry. You open everything, make tariff zero, like Singapore says, make tariff zero on everything. Okay, but then we have millions and millions of small units which may not be very efficient. They will be swept away by the import. So no country does that. No China, no Japan, no US. They may talk whatever. So we are large economy, and none of the large economies have 50% export as the GDP ratio. We have to make our economy efficient. When the pie enlarges, we need to enlarge the pie, which is GDP has to increase. GDP is not increasing, it's increasing at lower pace. We were talking about reaching 5 trillion last year only, FY 2024. Now we are saying 27. So by inflation at this rate, it will reach any time in 2 3 years time. But we say we have to focus on increasing the pie. How the pie will increase? That will increase by the individual contribution. We have to focus on manufacturing services at the enterprise level. How that can be done? So, like we were discussing, each sector has certain self-inflicted wounds which can be removed by promoting ease of doing business. We can list 10 things. For example, I'll give you just one example. This Trump tariff we are discussing. So I was receiving almost every day call from some of the friends, acquaintances, reporters, that what's the tariff on Apple, what's the tariff on computer. There is no place in India where you can find authentic tariff. In customs CBIC website, you will be lost in the maze and you cannot get a right answer. There is no place where you can. So we are a big country. We have to work on smaller things. We talk about big things always, that this
Mm.
much percentage growth and this sector will grow, EV will grow, and semiconductor will grow. Of course they should grow, but there are small level problems at the drainage level. We have to clear the drain, and those problems are run into hundreds for each sector. And if you talk, people who are in the sector, they all know about it. The problems are there. They persist for years. We don't solve them. We our imports are $700 billion. If you can't find an import duty on a fly, then what you are talking about to being big superpower? You go to American website or New Zealand website, Australian website, in a single click, entire tariff schedule you can download in Excel format and see everything so transparent. But somehow, but this is one thing only. I can count tens, hundreds of such things where nobody has interest. I mean, it's not the politicians who are saying don't do this. It is the people who are at the department level. Politicians are not interested in hiding all these things. It's not that government is against this. No, no, no. It's somehow not happening. Why it's not happening, it pains me.
In the interest of time, we will end this conversation here. Thank you very much for making time.